Hi, I'm David, Customer Success Manager at Northstar MLS. As the industry is navigating these changes, please know that Northstar MLS is here to help and support you along the way. Please let us know if you have any questions and do not hesitate to reach out to us. Our contact information will be provided to you. Thank you.
Big thank you to Team North Star for that. I want to echo a thank you, and I've got another little thank you slide kind of targeted toward them. But I want to also say thank you to Jackson for really helping out with this and getting us set up, and really he's really been a great addition here, and we're grateful for him. Also, welcome to the Dog Days of Summer, Dog Days download, summer 2024 market update. Also want to give thanks to our Marcom team, our marketing and communication team, for helping us get the word out for this and making sure there are a decent amount of people in here. All right. So let me go on to my little North Star thank you. I will say personally and professionally, I guess, thank you to North Star MLS. Also, RMLS of Minnesota Incorporated is, I think, that's their technical name versus their does business as name. Anyway, thank you to David, to Tim, Mike, and the team for sponsoring, for quickly adapting to this changing environment, as David referenced, for always serving our members and their subscribers in the best possible way, and for being the premier MLS in the Midwest and even the nation and beyond. And I actually really do mean that. For tirelessly seeking out the latest and the best tech that helps agents thrive, for just being committed to real estate, to the industry, and to all of our success, and for their really thoughtful and strategic leadership. I'm not sure everybody understands how lucky we are to have North Star. I knew Brian Larson a little bit. I knew John Mosey really well, and I don't know Tim as well as I'd like to, but I just hear the most positive things. So having sort of been around three different leaders at North Star, I've seen them at conferences, and I see how they have a following of other MLS professionals looking to them for what to do next, for what's coming next, for what technology is working or isn't working, for what kind of feedback you're getting from subscribers and what you're not hearing. So I'm not just saying that because we're a shareholder or because they're our local MLS. I'm saying that because they really, truly are the best, and I really mean that. All right. Today I get to talk about the love of my life, residential real estate. I still have a few jokes, so bear with me, guys. Before we
David,
get into it,
David, sorry, are you sharing your screen?
oh my goodness, am I?
No, I don't think you are.
I don't think I am. Let me make sure I'm
Yeah,
sharing.
before you got too deep into it. Yep.
All right, this is good. Yeah, and just a few of those notes. Thank you, Jackson. I've been doing this how long, and I still missed that. For just a few of those notes, I wanted to capture that here for everybody, and I suppose for the YouTube recording. Hey, YouTube watchers. All right, we're easing into it. I don't know if you guys are noticing this or if it's just me, but it seems like an awful season. You see those vehicles taking an alternate route over there? Yeah, we need to start construction over there too. So that is what we see. When you're on vacation, but you're a real estate agent, and that's kind of a little bit what your vacations might look like. Hey, you ever play any dangerous sports? I once tried to sell my house without an agent. That got a little dangerous, a little bit interesting. Here's Maury. You stated that you were not picky, but 62 showings in 5 months has determined that was a lie. I think that's all I got for the funnies, you guys. But every now and then when I find a cool one, I like to throw it in. All right. We have a lot of charts for you today. We have some words, some charts, some images, some graphs, some tables. You can have them. We send them out every time. You are more than welcome to have them. Use them in your social, at listing presentations, open houses, just to learn more, you name it. But I always like to show you guys where you can go to sort of fish for yourselves. And that is FastStat. So when you're right here at our homepage, mplsrealtor.com, either scroll down to the Today in the Market section or click on the market data section, and that's where you'll see all of our reports. All of you are pretty familiar with this map. If not, you should get familiar with it. And we always tell people to just bookmark Fast Stats, and that's where you'll see the local reports, the weekly, the monthly, foreclosure and short sale, all the way down to our annual report. So just FYI, making sure you guys know. So Jackson referenced, we're looking for a little bit of feedback this round. And maybe that's a little bit different than in the past, but I want to pose the question to you guys, and we will capture it. I want to pose the question to you guys. What are you looking for? What are you hoping to learn through market research? Are you guys being asked questions that you can't answer from clients? Let's think about that and talk about that. So if there's something you guys are kind of looking for, or something you feel is missing, or something you're curious about, please throw it in. And then Jackson and I will kind of look at it and see if there's anything we can do to sort of fill that gap or fill the need, if you will. All right, let's dive deep right away. Enough with all the niceties, right? These charts look as though they are familiar, and the metrics are familiar, but here's what's different, the time frame. So because we're really focusing on summer market, we might do a little bit, but we're not going to do a lot of year to date because we're kind of focusing on summer. We'll do a little year to date. And we're also not just looking at July because, again, we're kind of focusing on summer. You could argue May is late spring, and that, we still need August data to have kind of a full summer picture. But May, June, and July are really kind of the peaks of the market. New listings tend to peak a little bit sooner. Pendings tend to peak, May, June, and then closings kind of July. And so there's sort of that life cycle when it's newly listed, when it's active, when it's under contract, and then finally when it closes. So what do we see? Well, I see new listings are up 2.1%, which is not really that much off the floor from 2023, but a little bit off the floor. So kind of, forget the bubble, but after kind of recovery, and then we flatlined in terms of new supply, we've been pretty flat. So you guys can see 25,000 kind of fumbling our way down to, now just about 20,000. You'll also notice that is the third lowest for this period of any year in the last 21, 22 years. I'm pretty excited. Pretty soon we're going to have a quarter century of data, and that's a cool thing. So while it is discouraging to see, this decline, we know why. People are feeling stuck in their homes and married to their interest rates, and there's also no inventory. But it's also nice to see a little bit of a bump for this period. This is encouraging to see. Nobody can say we've seen the bottom and that will go nowhere but higher, but it sure looks like, at least temporarily, a bottom might be in terms of seller activity for the period, or for this period. All right, pending sales. Not seeing as much recovery activity when it comes to signed contracts. And again, we know that rates, the triple punch, rates, low supply, and rising prices are to blame. No surprise here. So really clear to just see this fall off a cliff as the Fed really started hiking rates to combat 40-year high inflation. What I suppose is slightly encouraging is that the declines are starting to soften or to ease. So sometimes we like to joke, before you can rise, you have to stop falling. We haven't stopped falling yet, but it looks like we could, soon. So let's keep an eye on that. Also worth noting, 19,900 is pretty darn close to that 20,000 level seen in 2004. Closings. Yeah, so closings sometimes a lagging indicator. And so remember, we'll talk about this, but the first quarter was actually fairly okay. I think the second quarter was surprisingly well, because of the rate environment, but I think many would say they were a little surprised at the weakness that they saw in the second quarter. So some of that activity from March, April, and I guess May is starting to close in June, July, I guess depending if it's a 30-day, 60-day, what have you. So closings are a lagging indicator, while pendings are a better leading indicator for demand. CDOM, cumulative days on market. What do we see happening here? I'm showing 15 days. That's up 25% from 12. That is the third consecutive year of double-digit increases, right? Up 28.5, 33 and a third, and now an even 25%. So market times have more than doubled from their bottom, from 7 to 15, right? 14, 2 weeks would be doubling, so it's a little more than doubled here. But I think the piece, I think the piece that's missing, that no one's kind of talking about, and sometimes we joke, you don't really hear this on CNN or Fox News. This 15 is actually lower than the pre-COVID trend, than these pre-COVID levels. So, 17, 17, and 17, down to 7, and then back up to 15. And so it is useful to kind of look at it in that way. Did I just see a question come through? Kristen, breaking this down to monthly. So because this kind of focuses on summer market, I've tried to do just that. I've tried to keep it kind of focused on the summer months, or at least the summer months so far. You'll see some July data alone, and you'll actually see some other months as well. So the focus is kind of going to be on looking at summer as a whole so far, but it's a good question. We will be looking at some monthly numbers. So, homes are selling faster, not quite as fast as they were. The trend is up, but the trend is also still below pre-COVID levels. So it can be both. We can see 3 consecutive years of double-digit increases in market times, and we can also still be below pre-COVID levels. Median sales price, making sense of the dollars, or whatever it is we're doing here. So most recently, for this period, for the May, June, July period, we show about a 2.75% increase, so up 2.7%, landing us at 385, right? 385,000. We were flat last year at this time, right? 375 to 375, so perfectly flat there. And I think, I think that's kind of compelling. And let me see if I can draw something for you guys. I'm struggling. Sometimes I think I'm fancier than I am here. Let's try the pen. We'll see if this works. Here we go. So, I want to kind of talk about this bump a little bit, because it's always kind of interesting to me. And if you sort of think about, a trend, seems like a decent trend to me, kind of cutting, close to the middle of each of these bars. What's interesting is, that's sort of the anomaly, right? And so we're kind of back on track, with this trend, if you will, right? And ask my wife, I'm far from perfect, but you guys kind of get a sense for that. And so, maybe we shouldn't look at this as, oh my God, it was flat. And maybe we should see, this is sort of the anomaly. And now we're kind of getting back on track, if that makes sense. And now I got a bunch of silly scribbles that I'm going to try to erase. There we go. All right, so just one other way to think about that, you guys. I just want us to have our thinking hats on, and I want you guys to feel, comfortable with talking about this stuff to your clients, not just talking about the value that you bring, particularly as a buyer's agent, and how how it's gonna go better when people use you guys. It's also worth just kind of understanding what's happening and how to convey that and thinking through what's happening. So let's keep trucking. I think next we have year-over-year change in price. Yeah, year-over-year change in the median sales price. And this is actually for every month of every year going back to January of 04. Sometimes Jackson and I will debate a little bit, just how far back should our data go? Sometimes it's useful to go back, enough time so we can sort of see these cycles. But, ordinarily, I think going back to 2018 or 2019 is usually fine. But you guys can see the great financial crisis and the mortgage crisis. You guys can see tax credit Then we kind of had to find our footing naturally. Then you had a lot of flippers and investors coming into the market. And then this was sort of normal, right? This was sort of a normal period. What, 5 to 10, 5 to 7% price gains. And then look at COVID. Here's COVID, where you saw 17% again, year over year. That's 1 year. And then you started to see the Fed hiking rates, demand really soften, and you saw prices actually come down for just barely 2 months, but it wasn't enough to bring the year down as a whole. Let's zoom in here. So talking about summer, right? So 24, so this goes through July. This 2.7% is July. And you can see, like we said, guys, first quarter a little bit stronger and a little bit weaker, in the second. But nothing too concerning, I guess I'll say. We were watching for this really closely. We were watching for, to see if those declines would continue, but they haven't. Again, nobody can say with certainty that we're out of the woods completely, but it sure looks like, we're in better shape, and it sure doesn't look like we're going to go back down below zero, especially given, the resilience of the consumer, how much pent-up demand there is out there, and the fact that rates are starting to come down. And we will talk plenty about that, I promise you. What else we got? PPSF, price per square foot. I was just talking about this with someone just yesterday in our parking lot. And it's funny, half the people love it, half the people hate it. It's just sales price divided by TFSF, total finished square footage, right? It's really that simple. But what we were talking about was, and we've talked about this before with several in this group, the issue is above grade is okay, but below grade is the problem, right? It's the below grade square footage. Not all below grade square footage, is created the same. If you have a Rambler with, a non-walkout lower level that's finished, that's going to be valued differently if you've got, a lower level that walks out to water, with a walkout, with a sliding door that walks out to water, for example. So that's different. So it's worth thinking about that. And yet it's also useful to have, an aggregate measure of what's happening with home prices when you adjust for the fact that larger homes are selling. I don't care how many square feet your home had. I care how much you paid per one of those square feet. And that's a good way to kind of make sure we're keeping things apples to apples. So $200 a square foot, that checks out for me. 2,000 square foot home is going to be just about 400K. Some 385, some 425, but kind of on average, or excuse me, I should say the median, just about $200 per square foot. Percent of original list price, another fun one, another good one. You guys know my 3 favorite metrics. It's not that I don't like looking at inventory and seller and buyer activity and prices. I love it. But my favorite 3 are market times, percent of original list price, and month supply of inventory. I think those tell you so much about what's happening sort of behind the scenes, and just sort of the balance of activity, and the power dynamic between buyers and sellers, who's kind of in the driver's seat, or who's holding the reins. Your pick your favorite analogy. My goodness, what do we see here? 99% used to be absurdly strong, right? 98.5, 99% was absurdly strong. And then we had to check out 91.3%, sort of when the market was in trouble. Don't forget little tax credit here that helped things, kind of help things along. And then when it disappeared, you can kind of see what happened there. Wow, what happened here? We must have had something happen. It was a pandemic. I think most of you were around for it. So all of a sudden, right, 99.8 to 104%. 104. That is just unreal in every sense of the word. And then we've come down 104 to 103 to 101, and now down to about 100. We're 99.9, which you guys will remember. That's a really strong number compared to the last cycle peak, but also compared to pre-COVID levels, right? So look at 2018, 19, and 20. Right? We're right in the middle, tied up with one of those, below one and above one, right? So we're right in the middle of kind of those pre-COVID years. So don't look at this as, oh my God, it's a decline. Yeah, sure it is, but it's also kind of even with where it was, if that makes sense. And I know it does because you guys are smart. So what we can say is sellers are getting, on average, 99.9%, about 100% of their list price. Some are getting more, much more still. Some are still getting 80, 90, 95%. It just depends on area, price point, and location. And condition, I guess you could say. So that was original list price. What about current list price? So this speaks to this idea that once you're priced right, you should be getting, all of your current list price. Now, these were sort of exceptional times, but these were sort of normal-ish. These were not normal-ish. Not normal. Not normal. Jackson, you should never let me have a pen. I never let me draw on these things. I don't know why they let me draw on these things. But you guys can see, 100%, once you have any kind of price adjustment and you have a current list price versus original, so you're originally at 419.9 or 429.9, but then you have a reduction to 399. Now it's your current list price. But once you make that adjustment, you're pretty likely to get, full price offers. So that is important to keep in mind. Inventory, what's going on with this one? Wow, 37,000 homes on the market. We now have not even 9,500. 9,500, not even. Well, this has been a thing, right? This has been the inventory story, and you guys can see with a couple kind of head fakes, we have been heading down, 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 and down for going on 17 years, 16 years. And so that's a long time to have that sort of pattern. And there's some evidence that it's changing. So let's erase what we've got and let's zoom in just a hair. And maybe I don't even need to, but I will anyway. So kind of fumbling around on the bottom, 83, 93, 84, 94. So we're kind of bouncing around on the bottom a little bit. I'm encouraged by this increase. 98. I guess I'm slightly encouraged by the fact that it's a little bit more, right? 9398, 9360. Yep, that's bigger. But buyers are looking for some signs that they have more options, especially some affordable options. In the 300,000 to 400,000 range, especially if you're a first-time buyer. So we've already seen it, but we're going to keep seeing it and keep talking about it. But you guys have already seen listings. What were they, up 2%? But sales were down, what was it? 4, 5, 6% something. So help me think about this. If supply is up, but demand is down, what does that mean? It means not all the listings are flying off the market as quickly, and actually some remain under active status at month end, which means they're counted as part of inventory. And so because you have supply rising, but demand, kind of soft, you have a little bit of a buildup in supply, right? A little bit of a buildup in supply. Now, are we suddenly at even 12,000 or 20,000 or God forbid 30 or 40,000? No, we're not. We're not anywhere near there. But I suppose we can also say we're not quite at the bottom. And remember, guys, this is just this 3-month period, and it's comparing to the same 3 months in all prior years. But what you'll see we've got some other good visuals that can sort of paint a different picture of what's been happening recently, the most recent data. Oh my goodness, it's 2:30. I got to keep moving here. Keep trucking. All right, month supply of inventory. So this one's pretty easy, guys. Month supply, we never average it out. We just take a snapshot at the end. So May through July month supply is the same as July month supply. So I won't spend a ton of time here. Here we are, 2.2 months of supply, up from 1.1, 1.3, and 1.8, but pretty tied up with 2.0, 2.1, and 2.2. In fact, we are exactly tied up with 2019 levels. So again, oh my God, absorption rates have doubled from 1.1 to 2.2. That's a fact, right? That's true. And yet, we're still a pretty strong seller's market, not as strong, but pretty strong seller's market still. And we're just sort of back to pre-COVID levels, right? We're back to these pre-COVID levels. So a couple different things to think about there, and hopefully some useful sort of talking points as you're in dialogue with your clients. All right, I promise this. New listings. Here's your most recent number, July of 2024. This just went live this morning. This just went live this morning. So you guys are getting the fresh ink hot off the press. I've noted sort of our summer period here that we're looking at. And remember, we're looking at new listings. So this is current year, the 63, and this is last year, the 5,400. And so, there you have your plus. We had some bigger, look at these pluses, you guys, starting in Jan, we were kind of excited that we were starting to see some supply coming onto the market. And then we took a little bit of a break. Then we went negative, which frankly, we were a little bit surprised by, but rates were high and sellers felt locked in and married to their interest rate. So sort of no surprise. And I guess we should say that builders they just weren't able to produce enough volume to move the needle. And so, we're a mostly existing home market. And now we're kind of back to plus 7.2. So that's encouraging. Over the last 12 months, we're up about 6.25%. I don't always show tables instead of charts, but when I do, I show the change in seller activity. Is that the most interesting man on earth or something like that? Homes for sale. I promised you we'd take a deeper dive. Actually, we'll take several deeper dives. Here's our summer. Here's our sort of dog days. And this is where things get interesting, guys. So focus up here at first. So late 2023, here's our kind of cutoff. We were still seeing inventory contract. As soon as, we started to see things sort of ease in November, December, like clockwork, we started to see pretty significant double-digit gains. I should have circled that one. We still have double-digit gains. And so this is telling us that, it's telling us just that supply levels are up, although demand isn't. And so we see, I should say new listings are up while sales are not up, which means we see a buildup in supply. I always have to be careful talking about listings because there's two kinds: new listings that were newly listed this month and active listings that are active this month, no matter when they were listed. Last month, 3 months ago, yesterday, what have you. So again, useful to kind of think about that. I don't always show tables instead of charts, but when I do, I show the number and change in signed purchase agreements. All right. Well, let's see what we can see here. Oops. Let's just see what we can see here. So here's our cutoff. Pending sales, we were seeing, plenty of negatives here when, with rates. And then we actually, as rates kind of broke, look at this, guys. We started to see some encouraging news when it came to sales, right? We were encouraged by this. Let's see. Just like I said, this was 1Q. I suppose this was technically, second Q, but I guess for our purposes, we're kind of focusing on this period. But guys, no matter how you slice and dice it, look, plus, minus, right? Big difference. Look at this. Sales were on the rise. We saw recovery in sales. And then, rates were just kind of stickier for longer. And we started to see actually fewer signed contracts than the year prior. And Jackson and I mean, again, it makes sense because of rates, but you just never know how resilient, consumers are going to be, how willing they are to stomach rates now and then maybe refinance later. are they going to be able to find the product that meets their needs? There's just unknowns, but it sure was tempting in the first 4 months of the year to think that, we're seeing a turnaround in demand. And actually, and let me erase and let me get my laser. Actually, what we're seeing is over the last 12 months, despite these gains here, over the last 12 months, sales are actually down about 1.5%. It's not a huge amount by any stretch, but they are down and new listings are up, and that matters. Days on market. I don't always show tables instead of charts, but when I do, we can see homes taking longer to sell. Okay, let's see what we can see here. Let's get our pen out. All right, here's our cutoff for the year. Yeah, market time's up, I guess flat a little bit, mostly up. Look, come January, March, Feb, boom. All down, all minus. Look at our transition month, April, flat. Look at the last 3 months, all plus. Do you guys see that? So when I say that the first quarter, was, fairly strong with sales, prices, market time, everything, this is what I mean. This is why we can say that. And you guys can say that too. You have all this. So home selling faster than the year prior in the first quarter, but then selling more slowly or taking longer to sell more days than the prior year for summer so far, right? For May, June, and July. So again, important to look at that, important to think about it. And you could very well be asked about it by your clients, and I want you guys to feel comfortable kind of talking about it. All right, let's just in case you guys don't believe me about what's going on, let's do it one last time. This time, percent of original list price. Cutoff. There's our December. Here is our first quarter. Wow, sure enough. Sellers getting a stronger share, a larger share of their original list price. How about the last 3 or 4 months? I guess I'll just do it again. Plus and minus, you guys. There was a difference. There was really a difference. And we are looking at that difference. So, I wish that I could sit here and say that we had a strong summer where buyers were ready, found plenty of options, and had no concerns about monthly payments. But I can't say that because that's not what happened. And believe it or not, facts still matter. What we are going to talk about is some evidence that things are shifting. So we'll get into some of that in the back half of our hour, or I should say in our final 20 minutes. One more plea. Please, please, please throw in chat, send us an email. What questions are you being asked? Buyers, sellers, investors, accidental landlords, out-of-towners, relo, whoever it is. What are you being asked that you guys are struggling to answer, or that you would like to be able to answer, more easily? So we really encourage you guys to think about that. We're here for you guys. Another interesting one. Am I saying that about all of my slides? Probably. Oh, hey, Christine has something. Oh, Esther, when will the market crash? Ugh. People have been waiting a long time, and I think they're starting to grab a third cocktail. So the larger price cuts, the longer the days on market. This is interesting. Look at days on market, 0 to 14, 15 to 21, 30, 60 to 90, 90 to 120. Price cut on pending versus the price cut on closing. So pending is just, think of this as price reductions, and think of this as seller pays, right? Or, seller pays closing costs or concessions or what have you. So look at, as market times grow, so do price cuts. Now, I guess this is sort of a duh, right? I guess it's sort of an obvious one, but here's what's interesting to me. This is the question I have. So what's really going on with that? I should have closed my Teams before I started here. So what's going on with that? So 2 questions. Is it that buyers assume listings with price cuts will have even more price cuts, and so they're waiting? And that something must be wrong with it, or it wouldn't be sitting for so long? Or is it that homes that have sat on the market for a while tend to have more price cuts in order to sell? It's probably a little bit of both. And Jackson and I, of course, lovingly call that multiple or multi-causality. There's more than one cause to that. Let's see, comparing price and percent. Christine is looking for month to month, not necessarily last year. It has progressive. Yes, it does. It does have this sort of seasonality or cyclicality to it. What we find is in December and January and February, sellers get, 96, 97, while in May, June, and July, they've been getting, pretty darn close to 100. And so we don't like comparing a June to a January only because June is always higher. But you're right that it is definitely useful to track that. Let's see. EA Lucas comments about the luxury market. Yes. Yes, we will touch on luxury. I've got some slides. Good question. Okay, speaking of price reductions, 45 to 50% of our listings required a price reduction before they sold. How about lately? COVID, everybody and their mother wanted to buy a house, mostly single family. And so only really 10% needed a price reduction. Right? Well, we were 20% kind of before COVID, and then that got chopped in half, 10%. And now we're back to 21%, which is technically at its highest level since 2017, but it's also pretty well tied up with 2018, 19, and 20 levels. We got to keep moving. Oh, how do I say this politely? You'll have to forgive NAR for some of the gaps on their axes here, on the y-axis and on the x-axis. That's not quite how I would have designed this chart, but here you go, kind of starting in 2015 all the way through May of this year, average number of offers received on the most recent sale. And by the way, guys, this is national. This is not Minnesota or Twin Cities. This is national. Even with a scale that's a little underwhelming, it's pretty easy to see where 2020 and 2021 are. Sure looks like they're right there, and now back down to 2.8. So it's not really that different than what it was pre-pandemic. But again, second reminder, this is national. And why would I mention that this is national? Why does that matter? Because that includes Manhattan and the Bay Area, as well as rural Nebraska and Louisiana. No diss on any of those places. They've all got their own successes and challenges, but they're very distinct and very unique places. And so that's just it, guys. National is just some aggregate average. It's not, right? Markets are local. National stats are aggregate, right? Are all aggregated. So take it with a grain of salt. Yeah, month supply of new and existing. Sticking with national before we get into our market. This we do have for our market, obviously. So for new in blue and then existing in red. And you guys will see these used to be pretty well synced up with one another, even here. And then you really started to see existing decline, but builders, they bought the dirt. They put the homes there. They're looking to get them listed and sold. Existing home sellers are still kind of feeling married to their interest rates. And actually, someone said something interesting, and I've heard it and thought about it before, but someone said there's a good chunk of people where if they had to buy their current home from themselves, they either couldn't or they would struggle to do so at today's prices and today's interest rates. That many would struggle with that. I don't think we could say most, but many would struggle with that. So here's locally, here is Twin Cities. You've got absorption rates for new homes in blue and then existing homes in red. New construction's a balanced market, guys, 5 1/3, right? 5 1/3 month supply. It technically got just above 6, which some call it 5 to 6 months. Maybe we can call it 4 to 7 months is pretty balanced. So not really a concern there. And then look at new homes, only 2 months of supply, and now back to 5 to 6 months. Existing homes still very undersupplied, still very much a seller's market there. Builders are willing to deal, though. They're willing to deal a little bit. Buy down rates, finishing a bonus room, finishing a basement. What else? Higher quality materials, whatever it is. So they're willing to play ball a little bit. And we do hear that anecdotally as well. Oh, Brad, you are asking a question that is not a timely one to ask. We don't have any compensation data anymore. The MLS has scrubbed it. We don't look at it. We really never looked at it. And we probably don't have any intent of looking at it for legal reasons. So while I appreciate the question, I will not be touching on that today. A different way to look at it. Again, you guys will get these slides. I won't spend a ton of time on this, but if you're talking with someone who's thinking about whether to go, new or existing, this is one way, one tool to kind of help with that. Days on market, new 36 days, existing 19 days. So what, a little over a month and a little under 3 weeks for existing. Interesting, existing actually up 5.5%, while new homes, new build market times down almost 20%. That was market times. What did I say? Absorption rates. That was market times. Sorry. Here's absorption rate. So there's 6.2. There's our 5.3 months. Balanced market. New home. The new home market is a balanced market. The existing market is still a very much undersupplied market because these existing homeowners are, what we just say, some of them would struggle to buy their current home from themselves at today's rates and today's prices. And so no surprise, they're kind of hanging on to them. Ah, yes, month supply by property type. Well, what do we see? Immediately, we can kind of see that condos are their own beast. They're their own animal, right? Single family in blue and townhomes in green, tend to follow each other, a lot more closely. You guys can see condos really look at the increase in condo absorption rates when the kind of condo bubble crashed. So all those listings just kind of sat, and that inventory sat while there was no demand. And so you saw that run up in absorption rates. And then look at condos after the pandemic and some of the fateful events in 2020. You guys can see condo absorption rates really come up. And then check this out. This was interesting too. They came down as I think, people were looking for payments to be under 2,000 a month or whatever they want. And so even some even millennial families with a kid, we're thinking about, maybe a two or three bed condo just so they can kind of get into something, right? And now you guys can see 2.2 months for single family, 2.1 for townhomes, but over 3, about 3 1/3 months for condos. So not all property types are the same. They're really not. You really do have to look. I don't know what I did there. Forgive me for that. Median days on market by price point. Interesting one. Here's million plus taking 275 days. 275 days. How about lately? Down 90%, about 10% of that, right? 280 days versus 28 days. That is just an insane change. That is just an insane change that we've seen in luxury. So someone was asking about luxury, and we're starting to get into that. 28 still taking the longest, right? 21, 18, 21, and then 28. So taking the longest, but look at that difference. Just look at that change. You can kind of see the bottom when the market was, really kind of at its hottest. And now we've seen market times come up across the board, right? You guys will see, I suppose, million plus down a hair, but you guys will mostly see plus signs here. Another last interesting thought, look at 18, a little sweet spot. So the cheaper stuff under 300, I should say, the more affordable product under 300, 21 days, but the 300 to 500 sweet spot actually 18 days. Maybe because some of that stuff needs more work, or it's not in school districts that some want, whatever it is. Could be a lot of different things. We got to keep trucking. Okay, cash sales, what's happening with this? So this is a usual one, guys. I'll just kind of blow through this one. We're still seeing, we updated this, and we're still seeing about 17.5% of buyers are using cash. So their deals are conducted entirely in cash. Highest level since 2013. That's an 11-year high. That's an 11-year high. It looks like the trend is maybe starting to level off. So I promise you will watch that. Contract for deed. A couple folks asked us to watch this. And so we have been. And no surprise why they asked us to watch this, because yeah, we were seeing an increase here. Looks like we're seeing a leveling off. That is good. As I think most people see this sort of loan product as a little bit of a riskier, loan product with the potential, with some potential for exploitation. I'm not saying that's always the case. I don't even think it's the case most of the time, but there seems to be a greater likelihood of that. And so as you guys see into the crash, kind of heading into the peak and into the crash, you guys see that was more common. We're only talking about 1%. We're talking about 0.25%. It's not worth spending much time on, but it's a trend, and it was doing that and then doing that and then doing that, and now sort of leveling off. So we like to point this stuff out. Another interesting thing we noticed, look at conventional loans. Look at the percentage of all sales that are financed using conventional financing. Folks were going the FHA route or other routes as the going got a little tougher, and now we're actually seeing conventional coming back just a hair. Can I say this is the beginning of a new trend? I can't say that. I can probably say I think it might be, but we cannot say that this is the beginning of a new trend. But I would suspect as rates normalize a bit and people's incomes kind of have a chance to catch up. Although wage growth has actually been fairly strong, I just think it'll take a little bit of time to kind of get back. But it does look like, well, let me say this. Some feared that the trend was going to go to 60%. And I'm not saying, one is better. I'm just saying FHA typically allows for lower down payments, and a little bit more lenient on credit standards. And so when you see people going to that product, it may suggest affordability challenges, other challenges. Obviously, it indicated affordability challenges, not probably, obviously. And so this is just one indication that some of that could be shifting. It's early. It's early. Market time by price range. This is a brand new one. This is a freshie. This is a freshie. Under 120,000, 250 to 350, all the way to over $1 million. Lightest bar, 2019, darkest bar, 2024. First things first, look at the sweet spot effect. I might have to draw on this. Look at our sweet spot effect. We see some sweet spots, sort of the most popular price ranges where people want to be, right? Next, in the most affordable, market times just kind of up, I guess down and up. Oh, down and up. Oh, down and up a little bit. Oh, so we're seeing some interesting things here, right? So, look at these patterns and, kind of versus these patterns. And so the market times just on something, let's just look at million plus, look at how long it used to take to sell, 150 days. Remember, we saw some were 270, but some of that was for a month or a rolling 12-month period. And this is kind of for the year as a whole, and they are different. Now we're seeing a little bit of an uptick in million plus, actually fairly flat. But you guys can kind of see how that differs. So I won't geek out on that any more than we already have. Percent of original list price, just the inverse. Sweet spot looking more like this now, right? So again, here's our sort of sweet spot right there, where those sellers tend to get the highest share of their asking price. Oh my God, is this amazingly informative? Look at the lower end. Look at the mid end. And look at the high end. Those are all different patterns, you guys. Those are all different radar signatures, right? Those are all different. And I think it's so fascinating. And we don't have time to talk. I think we could spend a half hour on this chart. And maybe the last one, but I will. I'll spare you of that pain and suffering. Month supply of inventory by price range. All right, here's another great one. On the rise in the affordable end, down and up, maybe kind of in the sweet spot, and then sort of way down and way up as we get into luxury. I think that's all I got of that set. Yes. Okay. All right. Love this one. I got to keep trucking fast though. Oh my God, how do we have this little time left? Change in showings in blue, right? Above zero, growth in showings. Below zero, a decline in showings. And we have plotted this along with the mortgage rate trend. So here's 7.5%, 7%, 6.5%. I swear I fixed those and I don't know how they got undone. Forgive me. Guys, these are inversely related. Rates higher, showings down. Rates down, showings up. Rates up, showings down. And now we're starting to just see rates break and starting to see showings start to turn higher. Yeah, new listings by price range. Not as exciting. We might skip that one a little bit. Interesting, but not too fascinating. You know, we see the most gains in million plus, but we actually do see some gains at the lower end. And then let me switch to pending sales. And this one's really informative. And not surprisingly, there's only two price segments where we see gains, and they are luxury and entry-level luxury, fledgling luxury, silver level luxury. I don't know, whatever you want to call it. Those were the only two with gains in demand. Why? Are buyers rate sensitive up there? Not really. These buyers are rate sensitive. You better believe they are. These guys, just not as much. And some of them are able to do cash. All right, let's get into luxury real quick. Million plus, July. Look at this, guys. Closed sales over 1 million. I'm still seeing a gain. I'm still showing a gain for July. Now, we could look year to date through July. I'm still seeing a gain, but not nearly as strong of a gain. And I'm also seeing we are down from peak, which I show as 2022. Now, this is metro-wide. Wayzata and Orono are not Edina or North Oaks, right? And so this varies by area. This does vary by area. Okay, a couple more as we're just sort of starting to wrap up here, guys. This was an interesting one. Demographics have changed, but have homes? Buyers, nearly 1/3 are single. And yet, you know, most are single family. We've never had more child-free homes, and yet we have almost 1,900 square foot homes. More multi-gen living, and yet most of our homes have 3 beds and 2 baths. So sometimes we like to think about whether the market is, you know, equipped to deal with the changes that are coming. Let me wrap up with this. Do you guys know Google Trends? Are you familiar with Google Trends? It's sort of a nerdy thing, but I think it's really informative as well. So what you can do is you can go on and you can search for what people are searching. I want to know what people are searching. So I've entered 3 terms: refinance, mortgage rates, and realtors or realtor. So blue, refinance. Ooh, look at that uptick. Mortgage rates. Ooh, look at that uptick. COVID, anybody? There's 2019, sure looks like COVID to me. And then turning up a little bit. So realtor looks like we could be turning up as well. Refinance, mortgage. I've just kind of included our inventory chart, and I think it's really interesting that searches for the word realtor may sort of correlate a little bit with inventory or maybe sales. So I thought that was fascinating. We're going to do more work to kind of look at that. Blue refinancing, red home loan. Look at the refi searches. We are going to see a flood of refis. We already have, right? So that's a lender kind of looking at what's going on. And let me, I suppose I wasn't going to close with that. Let me close with just some rate talk, you guys. Look, we were at 6.9% not that long ago. We had some good inflation news, and so we hit 6.3. Looks like this is pretty current, and we're back up to about 6.5, but give it a little bit of time. And very lastly, guys, I'm encouraged by what's happening, sort of with the technicals, if you will, on the rate front. You know, anyone who does some stock investing or trading, you know, kind of knows this idea of a support line. And then when we broke this support, we really headed lower. And now look at this support line. When we broke support, we really kind of headed lower. And so that's encouraging to me. There's also kind of a funny formation. It's called a head and shoulders formation, where if you kind of, you have a shoulder, then a head, then a shoulder. this usually means that we'll see a turnaround. And sure enough, here's a shoulder, here's a head, here's a shoulder. This is one view of what might happen. This is another view of what might happen. This is another possibility of what might happen. Here's another thing that could happen, guys. The truth is, and I'll bring in some of our gymnastics rock stars in a second. The truth is, we don't really know what's going to happen, right? But the other truth is, it sure seems like the path is lower. So who knows where things will land? And I think rates, just like our girl Suni, will likely come down from their high bars, and they may, hopefully, they'll stick the landing. Folks are saying Rocket Mortgage, Quicken, some of the lenders are saying loan application, loan volume increased by 20% beyond expectations. And so, we're already seeing that in a pretty significant way. Yeah, we did payments, headlines, guys. This moves markets. Headlines move markets. Headlines impact consumer confidence, all of it. Mortgage rates falling, mortgage rates falling. Homeowners rush to refi. Why mortgage rates will probably keep falling. Here's why mortgage rates dropped, right? Lots of different info, lots of reasons, and it's mostly all good stuff. So 30-year, closely tied to the 10-year treasury. Investors moved into treasuries after that jobs report was a little scary and it reignited some recession fears. Looks like markets don't think that anymore. So sometimes markets are kind of bipolar a little bit. Expectations, some would even say a near guarantee that the Fed will cut in September. I'm not saying it's a guarantee, but some have been saying that is almost a guarantee. Forget about the yen carry trade. Read about that if you want. And then the yield curve, read about that if you want. But as inflation's coming down, remember, housing makes up 42% of CPI, of the consumer price index. So home prices are still rising. But what have we seen? I think we just saw 2.7%. I think CPI was 2.9. So maybe finally home prices are actually having a little bit of a cooling effect on CPI instead of being a major driver. So I'm not going to do, we're already over time. I'm not going to do a whole economic update, but I will say these are the 4 indicators that most people watch for recessions: jobs, industrial activity, retail sales, and incomes. And when you see green, things are growing. We don't have all data for July, but guys, I'm not seeing any emergency flashing red signals that recession is right around the corner. It very well could be. It could be a sneaky one. It could be a mild, run-of-the-mill one. If Powell and the Fed somehow have engineered this soft landing, I think they'll go down in history and they'll be studied for a long time. So we're watching what's happening there. That is important. And then let me say this, and I know this is a little bit icky, but we kind of have to cover it. I know. Don't do it. Guys, it's really close, right? Some put him a little bit ahead, some put her a little bit ahead. Here's the thing. Does it matter? Yes, it does. Overall, yes. But what about housing? We really don't care who you vote for, but we really do strongly encourage you to vote. Note that presidential elections don't really have much of an impact. Existing home prices went up after 7 of the last 8 elections. New home prices went up after 10 of the last 11 elections. Mortgage rates decreased leading up to 8 of the last 11 elections. I thought the Fed was supposed to be nonpartisan, right? So we're getting asked what's happening in this election, with the last minute shift on one side and, whatever. And the fact of the matter is, it just doesn't have that much of an impact. And we want it to, and it doesn't. And with that, oops, I've gone too far. I will say thank you for sticking around. Looks like most of you have stuck around. Quick chat, comments, luxury. We kind of touched on luxury. Let's see, percent of properties, investor owned. Good question, Brad. That is one that I can and will answer. Let's see how quickly I can do this before everybody signs off. The Federal Reserve Bank of Minneapolis has a tool, investor owned. So that's where we look, because we don't really have a field in MLS to flag for us whether you're an investor or not. And then there's the question of, what do you call an investor? If it's a mom and pop duplex and they live on the first floor and rent out the second to offset their payment, are they really investors? Some would say technically yes, but others would say, let's set a cutoff. If you own 10 or more properties, let's have a cutoff. Or if you're looking for the big dogs like the BlackRock or, you know, whomever, Home Invitation, Home Partners, maybe call it 100. So this is a good tool. I'm happy to send the link. If you just Google MPLS Fed Investor Tool, there it is, right there. MPLS Fed Investor Tool gets you right there. They have a chart that'll show investor activity going from 1.5% up to 3.3%. So that is an increase, but it also says that 97% of the homes, single family homes that meet this criteria, you know, don't meet those, you know, aren't considered investor. The unfortunate but not surprising part is that, of course, there is a geographical element to this, and you see a lot of investor ownership in North Minneapolis, Powderhorn, Frogtown, East Side, and North End. And those communities have high populations of color. And so I'll just say again, it's not surprising, but it is saddening that that's the pattern that we see. I hope I've answered your question, Brad. And with that, just want to say thanks again, you guys, and for spending an extra few minutes with me. Thank you, thank you. We will send slides. The recording will be online shortly. And Christine, thank you so much for coming. Good to see you. Is that 3 weeks ago? Maybe a month ago. I was out at your shop. Always a good time. So thank you guys.